So where are interest rates going in 2025? Well, in today's video, I'm going to discuss my mortgage rates projection in 2025. And I will tell you just flat out, interest rates love chaos. Mortgage rates love chaos. And boy, oh boy, have we seen some chaos. Now, chaos can be good and it can be bad, but we'll get into that in today's video. If you're new here and you don't know who I am, my name is Rick Elmendorf and I'm a mortgage loan officer specializing in VA loans. But in today's video, we're going to be discussing mortgage rates. So this would be anything, VA rates, FHA, conventional, jumbo rates. Really, it all ties together because interest rates do the same thing pretty much across the board. It's not like you're going to have one rate get better and the other rates not, or vice versa. So with that said, let's get going. Well, first and foremost, when you're talking about interest rates follow inflation. Mortgage rates follow inflation. And there's a little dial that the Federal Reserve uses to affect interest rates. Now, they don't directly influence mortgage rates, which is exactly what we're seeing now. In the very beginning, in January 2nd of 2025, I'm sitting here and seeing this manipulation by the Fed, not really kind of being shrugged off by the mortgage rates today. But let's kind of just backpedal here a little bit to say mortgage rates follow inflation. The Federal Reserve has tools in their toolbox to tweak mortgage rates. In fact, what they're doing is they're tweaking inflation. They're making changes to what we call the federal funds discount rate. But the way they mainly change mortgage rate is by raising or cutting the federal funds discount rate. It's highly thought of that if the Fed cuts rates, and this is just kind of the broad term, that's going to cut mortgage rates. That's actually not what happens. In fact, it's kind of a converse relationship. You see, in my earlier statement, I said that mortgage rates follow inflation. So if the Federal Reserve is cutting rates, what they're trying to do is spur an economy that they feel needs a little bit of a lift. By lowering the federal funds discount rate, they're essentially lowering the rate that are charged to the bank by borrowing from the Fed. Really what that does is it affects the consumer. At the consumer level, the cost of borrowing is lower. So your credit card interest rates are lower. If the Fed drops the federal funds discount rate, your prime rate is lower. That's going to be affecting home equity rates, credit card rates across the board. So more money enters into the economy and therefore more spending, therefore more inflation, actually, right? So more demand for products, the higher the prices should be pushed. So that's kind of the idea when the Fed lowers the federal funds discount rate, that they're actually trying to spur the economy. We had massive inflation. Now, one of those things that led to the massive inflation was this incredible price tag of government spending. I won't get off on a tangent, and I'm certainly not going to get political in today's video, but let's just say the government plays a big part in what the Fed ends up doing with toolbox, let's just say. And what they had to do to curb this massive inflation that we saw just over the last several years is to jack the federal funds discount rate. But government spending does play a big part in what the Fed does. But I personally think that, and just from my chair over 30 years of doing this mortgage business, is that there's a typical spread between where inflation is and where mortgage rates are. We'll just call it the average mortgage rate. So the average mortgage rate is sitting around 6.8% at the time of this video. I'm almost done with their mortgage cuts, which, by the way, are not a bad thing. When the Fed cuts rates, the federal funds discount rate, this is actually inflationary. Remember, it's to spur the economy. So that's inflationary, and mortgage rates hate inflation long term. And conversely, when they start cutting, then that's where mortgage rates tend to come down. The whole purpose of raising interest rates is to lower inflation. Then mortgage rates actually like that. What confuses everybody is that why then, of course, are we seeing the Fed jack interest rates and the mortgage rates are going up? That's because the mortgage rates are very forward looking. They look forward into what's going to happen. But where are mortgage rates going? I see mortgage rates because the inflation rate is 2.7% and mortgage rates are at 6.8%. That is 4.1% on an average basis. And when the higher than inflation. You're 4.1% higher than inflation right now is the average mortgage rate. That's too high. I'm telling you right now that typically you're going to see mortgage rates anywhere from 2 to 3% over the inflation rate. So what does that tell you? It tells you that the market is just like, dude, I'm just sitting here waiting to see what's going to happen. And that's where we are in early 2025. President-elect Trump is going to take office on January 2025. So you have all of these kind of what if scenarios going into 2025. So what are the markets doing right now? We are 4.1% higher than inflation right now. It's way too high. So I see rates falling to that 3% over inflation, which means rates have to drop to an average rate of about 5.8%. Okay, that's where I see interest rates going in 2025. Now, VA loans are completely different. A lot of lenders use VA to pad their other mortgage programs. And this is why it's so important that you get a comparison, especially if you're a VA buyer, home buyer, or looking at a VA refinance. So for VA loans, you're typically going to have a spread. What you should have is a spread of about 0.5% better in rate on a VA loan. But VA rates are going to be a lot lower than your conventional. So VA should be about 2 to 2.5% over the inflation rate. So if we're looking today, 2.7% plus 2%, 4.7%. And where are VA rates? About 6%, 6.25%. That's where they are today. It just makes no sense. Now, again, maybe Rick is wrong. I could be wrong, and I could be this 1% lower than today could be a pipe dream, but I'm not wrong. You'll see it, and hopefully you can watch this video in like August of 2025, and you're gonna be like, hey, Rick was right. Look at that. Okay, or you can say, yeah, Rick, you're an idiot. You can just comment idiot or something if I'm wrong, or genius if I'm right, and do every loan with me. This whole thing of the spread, if nothing happens, nothing happens at all with anything, mortgage rates should just naturally fall. That's kind of what I'm getting at. As I mentioned, government spending is highly inflationary. So this thing with Doge, think about it. If the Federal Reserve cuts $2 trillion out of the budget, what is that going to do? Honestly, I don't even know what $2 trillion is going to do to the market. It's going to be interesting. That combining with the tariffs. So tariffs are going to be inflationary. Cutting spending is going to be good for mortgage rates. So this is why the markets are like, dude, we're just going to wait and see. That's what's happening. All right. But that'll be very interesting. If we do get all that spending cuts, I think interest rates are going to go even lower than 1%. The other thing that are potentially going to affect mortgage rates, and I really hope that as we watch this video in the future, you saw what happened in COVID. The stock market is not as secure as the mortgage markets. It just hasn't been historically. And kind of you can look at a mortgage bond as kind of like a bond, like a safe government bond. All right. Money is in three places. You've got cash, you've got stocks, and you've got bonds, right? Typically what happens is money will go into stocks, they come out of bonds, or they come out of stocks and into bonds. If they go into bonds, what's going to happen? That means more people are buying bonds, the price of the bond goes up, and the yield goes down. The yield going down is actually good for mortgage rates. So as money comes out of the stock market, the mortgage rates are typically doing better, and then the converse is true. But all of these normal dynamics have been kind of out the window because of all these people sitting on their cash. And again, I'm not an economist, and I just can tell you this, the principles that are at play here is that that's how money typically works. Money, if the stock market is going nutso crazy, typically you're not going to see mortgage rates improve. And in fact, if the stock market is coming down, then you're going to see mortgage bonds go higher and mortgage rates come down. But what is going to be facing the home buyer going into 2025? And this is the catch-22 of rates, competition, home prices. If I'm right and we start seeing interest rates go down, NAR threw out a statistic that said that if mortgage rates drop just 1%, that you're going to have 5 million new home buyers enter the market. I think that number is way higher. I think it's way, way higher than 5 million home buyers, because the amount of people that have been sitting on the fence is just astronomical. I see massive influx in pre-approvals when the rates drop 0.25%. So there's this interesting dynamic. As rates drop, more competition comes in the market, more buyers come in the market, pushing prices higher. Lower interest rates are good for buyers, right? But they're good for a lot of buyers, a lot more buyers, and they're really good for sellers. I've been telling people a long time, the best time to buy a house is 5 years ago. But to finish up this video, where rates are going in 2025, I believe that the average mortgage rate for 2025 will be in the fives. Personally believe we're going to be sitting at 5.6%, 5.8% by the end of 2025. I may be wrong and I may be better. I think VA rates are going to be in the low fives. That's just my prediction. And we will see as time prevails and mortgage rates do what they do. This is Rick. That's my prediction. Lower rates in 2025. It's going to be a good year. Go out, buy that house now. Hopefully you're listening to me in January and you go out and buy that house now before all the droves of people come. If any of these things I'm saying were just kind of, I highly recommend you to schedule a call with me or my team. We can schedule a 15-minute introductory call, strategy call. Leave me a comment as well. We do respond to those and be happy to serve you. Again, this is Rick Elmendorf, and I'll see you on the next video.